Hey everyone! Today we're diving into a topic that tends to make investors break out in a cold sweat: market crashes. But stick with me, because by the end of this video, I'm hoping you'll see why these dramatic downturns shouldn't send you running for the hills. In fact, they might even present some golden opportunities if you approach them with the right mindset. This is the Finance Virtuoso channel. If you're new here, hit subscribe and the notification bell for the best money tips and tricks. Now, I get it. The idea of watching your hard-earned money seemingly evaporate overnight is enough to make anyone panic. But here's the thing: when it comes to investing, our perception doesn't always match reality. So let's break down why market crashes, while certainly attention-grabbing, shouldn't be the boogeyman keeping you up at night. First things first, let's talk about the long game. One of the biggest mistakes new investors make is focusing too much on short-term market movements. It's like trying to predict the weather by looking out your window for 5 minutes. Sure, you might catch a raindrop, but you're missing the bigger picture. When we zoom out and look at the historical performance of markets over decades, a clear pattern emerges. Despite all the ups and downs, crashes and booms, the overall trend for most markets is upward. It's not a straight line by any means, but the general direction is clear. Let me throw some numbers at you to illustrate this point. Vanguard's original S&P 500 index fund has skyrocketed from about $20 a share in the mid-1980s to over $400 a share today. That's a 20x increase. And it's not just stocks, bonds, real estate, precious metals, they've all shown similar upward trends over the long haul. But what about when the market takes a nosedive? Shouldn't I be worried then? It's a fair question, but let's dig a little deeper. Here's something that might surprise you: most market downturns are actually pretty short-lived. I know when you're in the middle of one, it can feel like it's going to last forever. But the data tells a different story. For most asset classes, the typical downturn doesn't even last a full year. And in terms of depth? Well, outside of some outliers like precious metals and commodities, the average downturn doesn't even hit double digits percentage-wise. That's not to say we don't see bigger crashes, we absolutely do. But they're the exception, not the rule. Let's talk about those exceptions for a moment, because I think this is where a lot of people get tripped up. We tend to remember the big, dramatic market crashes because, well, they're dramatic. The Great Depression, the 2008 financial crisis, the 2020 COVID crash, these events stick in our minds and color our perception of market risk. But here's the kicker: even during these major downturns, the recovery often comes faster and stronger than most people expect. Take the Great Depression, for example. When the stock market finally bottomed out in the summer of 1932, what do you think happened next? In the following 3 months, not years, months, the market saw returns of 5%, 50%, and 12%. That's a mind-boggling turnaround. Or look at the COVID crash in 2020. The market tanked hard and fast, no doubt about it. But then what happened? It bounced back with a vengeance, recouping most of its losses in a matter of months. If you'd panicked and sold at the bottom, you would have locked in those losses and missed out on the recovery. This brings me to an important point: timing the market is incredibly difficult, even for professional investors. Think about it: to successfully time the market, you need to be right twice. You need to know when to get out before a crash, and then you need to know when to get back in before the recovery. Get either of those wrong, and you could end up worse off than if you just stayed put. Now, I'm not saying you should never adjust your investment strategy. But making drastic moves based on short-term market movements or trying to predict the next crash, that's a risky game that even the pros struggle with. So what should you do instead? This is where the magic of dollar-cost averaging comes in. Instead of trying to time the market, you invest consistently over time, regardless of what the market is doing. When prices are high, your money purchases fewer shares, but when prices are low, you get more value for your money. Over time, this approach tends to smooth out the peaks and valleys. But let's say you're still not convinced. You're worried that we're on the brink of a major crash and you're tempted to wait it out on the sidelines. Well, I ran some numbers on this, and the results might surprise you. I created a simulation comparing two approaches, investing a lump sum of $10,000 right away versus waiting for a 10% market drop before investing. I ran this simulation 100 times, using randomly generated returns based on historical data. Want to guess what happened? The investor who started right away came out ahead more often than not. Not only that, but their typical margin of victory after 30 years was around $40,000. That's a pretty significant difference. Now, of course, there were scenarios where waiting to invest worked out better. But here's the thing, those scenarios were less common, and even in the best-case scenario for waiting, the potential upside was smaller than the best-case scenario for investing right away. Why is this? Well, it comes down to a few factors. First, as we discussed earlier, markets tend to go up more often than they go down. Second, when markets do go up, they typically do so faster than when they're falling. And third, by investing earlier, you're giving your money more time to compound and grow. There's also another factor at play here that I like to call the slingshot effect. This is what happens when you keep investing through a downturn. Let me paint a picture for you. Imagine you start investing and immediately hit a rough patch. The market drops 20% 2 years in a row. Ouch, right? But you keep investing because you're in it for the long haul. Then, over the next 3 years, the market rebounds strong, gaining 25%, 30%, and 35%. What do you think happens to your net worth? It shoots up like a slingshot. Because you kept investing when prices were low, you accumulated more shares. So when the market rebounded, your portfolio value didn't just recover, it launched past where you started, ending up nearly triple what it was at the market bottom. This is why staying the course and even increasing your investments during downturns can be so powerful. You're essentially buying more shares on sale, setting yourself up for bigger gains when the market recovers. Now, I want to be clear here, I'm not saying market crashes are fun or that they can't cause real financial pain in the short term. They absolutely can, especially if you're nearing retirement or you need to access your investments soon for some other reason. That's why it's crucial to have a diversified portfolio that aligns with your risk tolerance and time horizon. If you're young and have decades until retirement, you might be comfortable with a more aggressive, stock-heavy portfolio. If you're closer to retirement, you might want a more conservative mix with more bonds to help cushion against market volatility. The key is to have a solid investment plan in place before a crash happens. That way, when the market does take a dive, and it will at some point, you're not making decisions based on fear or panic. Instead, you can view it as an opportunity to buy more of your investments at a discount. So, to wrap this up, here are the key takeaways I want you to remember. 1. Market crashes, while scary, are a normal part of investing. They're the price we pay for the long-term growth potential of the stock market. 2. Historically, markets have always recovered and gone on to reach new highs. It might take time, but patience is rewarded. 3. Trying to time the market is incredibly difficult and often counterproductive. You're likely better off staying invested and riding out the storm. 4. Dollar-cost averaging and consistently investing through downturns can actually set you up for bigger gains in the long run. 5. Having a diversified portfolio aligned with your risk tolerance can help you weather market storms with less stress. By understanding the nature of market cycles and sticking to a solid, long-term investment strategy, you can turn those scary market crashes into opportunities for growth. That's all for today, folks. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss out on future content. And hey, if you have any questions or topics you'd like me to cover in future videos, drop them in the comments below. Until next time, happy investing.